Global equity markets exhibited a mixed tone over the week ending December 19, 2025, navigating through a complex interplay of central bank signals, inflation data releases, and geopolitical undercurrents. While optimism about moderating inflation and cautious optimism from key central banks provided some support, investors remained circumspect amid lingering concerns over liquidity conditions and the sustainability of recent gains, especially in technology sectors. In the United States, the Nasdaq and S&P 500 indices remained largely range-bound, reflecting investor hesitation even as Nvidia shares attracted particular attention due to a notable discount to the chip sector index, suggesting a recalibration of valuations in this high-growth segment. European markets, meanwhile, grappled with inflation readings that continued to show stickiness in certain segments, tempering enthusiasm despite corporate earnings holding up reasonably well. The global inflation landscape this week was characterized by a nuanced picture. Core inflation metrics in major economies showed signs of plateauing but failed to deliver the decisive downward break that markets had hoped for. This reinforced the cautious stance adopted by several central banks, notably the Federal Reserve, which indicated that while the peak of rate hikes might be behind, a patient approach to further tightening could still be warranted depending on incoming data. The European Central Bank echoed similar sentiments, emphasizing vigilance against inflationary pressures, particularly in energy and food prices. Meanwhile, the Bank of Japan maintained its ultra-loose monetary policy, underscoring the divergence in global monetary settings. In India, the Reserve Bank held its policy steady, signaling a wait-and-watch stance as headline inflation remained within the target band, supported by stable food and fuel prices. However, the banking system's liquidity showed signs of tightening, with overnight rates occasionally breaching the repo rate, reflecting a cash squeeze that could influence lending rates going forward. These global developments had a palpable impact on Indian markets. The BSE Sensex and NSE Nifty 50 indices experienced a recovery towards the latter part of the week, buoyed by improved foreign institutional investor inflows, the highest in 8 months according to Brokerage reports. This inflow was partially attributed to a renewed global risk appetite amid hopes for more accommodative central bank policies in early 2026. Nevertheless, the markets faced resistance around key psychological levels, with the Nifty attempting to reclaim the 26,000 mark but falling short decisively during midweek sessions, as technical analysts noted the index's need for a decisive breakout above this threshold to sustain momentum. The broader Nifty 500 index mirrored this cautious optimism, showing moderate gains but lacking vigorous upward thrust. The banking sector, as reflected in the Bank Nifty index, consolidated after a period of volatility, influenced by sector-specific developments such as the finalized MUFG Shriram Finance deal, which saw Shriram Finance shares hit a 52-week high, injecting some positive sentiment. Sectorally, the week was marked by a broad-based advance with notable outperformance in realty and automobile stocks, which benefited from steady domestic demand indicators and policy support signals. The pharmaceutical and healthcare sectors also registered steady gains, supported by robust earnings and favorable government initiatives aimed at healthcare infrastructure enhancement. Conversely, the metals sector lagged, weighed down by concerns over global demand and commodity price volatility. Information technology stocks extended their gains for the third consecutive day, with the Nifty IT index reaching intraday highs, although brokerage houses like Jefferies issued cautionary notes citing downside risks following muted guidance from global IT services peers such as Accenture. On the other hand, energy and utilities remained relatively subdued, despite Tata Power's successful issuance of non-convertible debentures, reflecting investor prudence amidst sector-specific uncertainties. On the stock-specific front, several developments caught market attention. Infosys ADR shares experienced an extraordinary short squeeze, leading to a near 40% spike and triggering trading halts due to volatility controls. This episode underscored the thin liquidity and heightened speculative interest in certain overseas listed Indian stocks. ITI Limited surged on announcements of land parcel monetization plans aimed at raising significant capital to clear debt and employee liabilities, reflecting corporate restructuring efforts that resonated positively with investors. Waaree Energies saw a notable uptick following its announcement of a strategic $30 million investment in United Solar, signaling its international expansion and focus on renewable energy solutions. Meanwhile, Volta's shares retreated amid subdued demand expectations highlighted by brokerages amidst multiple headwinds, indicating sectoral headwinds in consumer durables. The IPO space remained active with Gujarat Kidney and Super Speciality gearing up for its public offering, which attracted robust anchor book subscriptions, signaling investor appetite in healthcare-focused offerings. Additionally, ICICI Prudential AMC made a solid market debut with a listing premium, reflecting strong investor interest in asset management companies. Brokerage houses maintained a cautiously optimistic tone overall. Analysts highlighted that while Indian equities present attractive medium-term opportunities owing to strong domestic consumption trends and structural reforms, near-term volatility is likely to persist given global uncertainties and liquidity fluctuations. Research houses like Elara Capital pointed to the improved foreign inflows as a positive signal but cautioned about the potential for near-term corrections if markets fail to consolidate recent gains. Meanwhile, sector-focused brokerages recommended selective exposure, favoring high-quality banks and NBFCs with diversified credit portfolios, especially those with MSME and corporate lending focus, which are expected to deliver mid-teen returns in 2026, as per insights from prominent strategists. Technical analysts emphasized the importance of the Nifty breaking decisively above the 26,000 level to confirm sustained momentum, while a record low volatility index suggested that markets might be vulnerable to sudden shifts in sentiment. Looking ahead to the coming week, investors should closely monitor key economic data releases, including industrial production figures and further corporate earnings updates that could provide insights into the health of the domestic economy and corporate sector resilience. Global monetary policy developments remain in focus, particularly any commentary from the Federal Reserve and the ECB on interest rate trajectories and inflation outlooks ahead of the year-end. Additionally, the IPO calendar warrants attention with Gujarat Kidney and Super Speciality's public issue subscription and allotment processes unfolding, which may set the tone for primary markets in early 2026. Market participants will also be watching developments in liquidity conditions within the banking system, as any further tightening could influence credit growth and equity market sentiment. Furthermore, geopolitical developments and commodity price movements, especially in energy and metals, are likely to continue exerting influence on market dynamics. In the medium term, spanning 2025 to 2026, the outlook for Indian equities remains constructive, underpinned by robust economic fundamentals, ongoing structural reforms, and an expanding domestic investor base. The government's reform agenda emphasizing diversification, infrastructure investment, and capital market deepening is expected to create a conducive environment for sustainable growth. Financial sector reforms and the strengthening of corporate governance frameworks, as highlighted by regulatory authorities, aim to enhance market integrity and investor confidence, critical for attracting long-term capital. Technology and renewable energy sectors are poised for growth, driven by innovation and policy support, although valuations will require careful scrutiny. Volatility is likely to remain a feature given global macroeconomic uncertainties and geopolitical risks, necessitating a disciplined and selective investment approach. Overall, investors should focus on quality companies with strong balance sheets, sustainable earnings growth, and exposure to secular growth themes to navigate the evolving landscape effectively. This commentary is provided for informational purposes only and does not constitute investment advice or a recommendation to buy or sell any securities. It is not prepared by a SEBI-registered analyst and should not be relied upon as a substitute for professional financial consultation. Investors are encouraged to conduct their own due diligence and consider their risk tolerance before making any investment decisions.